Clean Science and Technology is a very interesting company in the specialty chemical space. It is known for its green chemistry, cost-efficient processes, and high-margin products. The company supplies across industries like pharmaceuticals, agrochemicals, personal care, and food ingredients. On top of that, a large share of its revenue comes from exports, which makes its business more diversified and less dependent only on India. The balance sheet is almost debt-free, asset-light, and that is what makes investors treat it as a high-quality compounder. Looking at the latest performance, in the first quarter of FY26, revenue grew by almost 10% year-on-year to around 234 crore. Net profit stood close to 70 crore, which is a 6% growth compared to last year. The most impressive part is the EBITDA margin, which is still above 46%, among the best in the chemical sector. Return on equity is around 19%, which is healthy, though a bit lower than the peak levels the company enjoyed a few years back. Now, if we look at the longer track record, Clean Science has delivered around 18% sales CAGR over the last 5 years, and almost 28% profit CAGR. Its return on capital employed is strong at about 25%, with virtually no debt on the balance sheet. The company has the capacity to keep investing in expansion and innovation. Dividend payout is steady, though the yield is not even 1%, which means investors are not here for income, but mainly for long-term capital appreciation. Coming to valuations, this is where the challenge comes in. The stock is trading at a price-to-earnings ratio of around 44 to 45 times, and a price-to-book of nearly 8.5 times. Most intrinsic value models suggest the stock is trading 30% above fair value. So while the quality of the business is outstanding, the current market price leaves very little margin of safety. From a technical point of view, the stock has been underperforming sector benchmarks in the short term. Momentum is weak, and charts suggest support zones are around 1,050 to 1,100. Resistance is visible around 1,250 to 1,300. If the company maintains its margin profile, fair value over 1 year can be closer to 1,350 to 1,400, but that still doesn't justify aggressive buying at the current premium. The strengths are very clear. Clean Science is innovation-driven, a global leader in niche chemicals, debt-free, highly efficient, and enjoys one of the best margins in the industry. These are all qualities of a long-term wealth creator, but the risks are equally important. Valuations are stretched, profit growth is slower than revenue growth, and if input costs rise, margins could come under pressure. So what should investors do? For value investors, this is not the time to chase the stock. The smarter strategy is to wait patiently for corrections or accumulate slowly near support levels. Clean Science remains a quality compounder, and the long-term story is intact, but buying at expensive valuations can hurt short-term returns. In other words, it's a stock to keep on the watch list and enter gradually when the market gives the opportunity. Disclaimer: this analysis is for educational purposes only and does not constitute investment advice. Please do your own research or consult a financial advisor before making investment decisions.